All right, we have a segment that I had recorded earlier today, being Sunday, June 4th, 2017. I'm including this with the live segment that's airing tonight, but I will put this standalone because this information is pretty invaluable. Lional Parkinson, who has been with the show, on the show several times, most notably for his work on his book, Holy Virus. But that aside, he has come on the show a couple of times to warn people of trusting more conventional methods of maintaining their value of their money, like even gold, for example, and also was talking about short-term during the collapse, when, for example, when the banks close, you won't have your ATM card, you won't have your credit card, but you will have cash if you have some at home, and that will be actually increasing in value short-term because nobody will be able to buy anything. So you can get good deals on products with cash. So those are, I just summarized some long interviews we did, and I will put those links below so you can revisit them if you haven't listened before. But what we are going to talk about now is, I was talking with Lionel on the phone as I was driving, and he had stumbled onto some funds that are basically, if I could put it in simple terms, selling the banks and the market short, which means that if the stocks go up, the bank stocks go up, S&P goes up, this funds go down, which they have done. But if those aforementioned crash, these skyrocket, which they have done in the past, and we will see. And I thought that it would be very important information to have Lionel on the show to discuss this, and we can show some graphs and whatnot. And again, we'll put all the links down in the description so that you can go yourself and check these things out and monitor them. But it's quite fascinating. And while we could say the old past performance is not indicative of future gain, if you're dealing with something as simple as market goes up, this stock goes down, and markets go down, stock goes up, it's not a bad thing that you can look into the past and get some solace. So let me bring Lionel on the show here. Let me push a button, and welcome back, Lionel.
Hey, thanks a lot, James. I really appreciate this program because I like doing this particular idea that I shot past you in our private talks. So I hope this will help somebody out there that is extremely worried about what might be coming down the pike, that might be studying this issue, our financial system and our freedoms being taken away through higher taxation. So I just wanted to take this time and use this program as a vehicle in which the listener might want to use this idea. They might not, but we'll just get into it, if you don't mind, and let them decide.
Right. Go ahead. Now, I got some, I have some, if I'm going to be corrected on my English, some charts and websites and all that. So as we're talking, I will switch the various charts and whatnot to show people who can watch here. This is recorded in HD, so it can be easily viewed. But again, these links will appear on the bottom. So go ahead.
Okay. In hoping that you have this one chart up, I wanted to show the listener what the total savings deposit at all the depository institutions in the United States. And this is recorded by the St. Louis Federal Reserve. And at the upper left-hand corner, it will give you the exact amount of savings in our institutions recorded on May 22nd, 2017, and that figure is going to be $8,882 billion in savings. I want the listener to keep that figure in their minds as I'm talking on this subject, because the synopsis of this whole program is to provide an idea of what's going on behind the scenes with people's deposits and how we can turn this around and hopefully save people from losing their money in the banks. Because if your money is in the banks right now, the laws have changed down through, especially within the last decade, that the legal ownership of all the deposits have now gone over to the banks. Now, to give you an idea, this was done through the Dodd-Frank bill, and when you deposit money in a checking or savings account, that money no longer belongs to you. Technically and legally, it becomes the property of the bank, and the bank just issues you what amounts to is an IOU, and the bank considers this as an unsecured debt. This is already written down by law, and the Dodd-Frank bill will deprive the citizens of the United States of those rights guaranteed to them under the constitutional law, to their right to life. They will be deprived of their right to petition their government over this issue, and they will be deprived materially, and certainly that many will be deprived of their lives by violence, poverty, and starvation. This act, referring to the Dodd-Frank bill, will act much like the Cyrus-style bail-in mechanism that enabled the government to transfer enormous amounts of wealth from the collapsing banks into the hands of the private cartel that controlled the new orderly liquidation authority, which today the Federal Deposit Insurance Corporation has no longer been authorized to insure your bank account. It is now a confiscation agency for the banks. So keeping in mind that all that $8.882 billion has now legally been transferred over to the major banks, they now own that money. And what they do is they loan it out to corporations. Now, I did a study on what the S&P is one of the America's largest credit agencies. It monitors the financial health of corporate America. And recently, the S&P looked at the balance sheets of 2,000 U.S. corporations. It published the results of this study back in May of 2016. And the findings are really startling. According to the S&P, U.S. corporations have $1.8 trillion in cash on their books. But the bad news is that more than half of this cash belongs to only 25 companies, or about 1% of corporate America. And that group includes the tech giants like Apple and Microsoft. Meanwhile, the rest of the corporate America is racking up huge debts while having little cash on hand. If you remove the top 25 cash holders, you'll find that for the most of corporate America, cash on hand is declining even as these companies rack up more and more debt at historic rates. The bottom 99% of corporate borrowers have just $900 billion in cash on hand to back up $7.5 trillion in debt. This results in a cash-to-debt ratio of just maybe 10%, the lowest recorded over the past decade, including the years preceding the Great Recession. The cash-to-debt ratio compares how much cash a company has compared to the debt, their borrowed debt. The higher the ratio, the better. A cash-to-debt ratio of 10% means companies have just 0.10 or 10 cents cash for every dollar of debt. This is significant because remember that $8.882 billion savings that people have saved up for decades has been loaned out to corporations that have no intentions on paying back the $7.5 trillion that they've racked up in debt. This is, in my speculation, this is where corporations have taken that borrowed money from the banks that used to belong to the depositors, and they're buying back their stocks and pushing up the stock market very high, while those at the very top of these corporations get their money out, knowing full well that they cannot ever pay back the amounts of money. I'll give you an example of General Motors. General Motors made $16.5 billion from its ongoing business operations in 2016. They had to spend an incredible $29 billion in capital expenditures just to sustain the business. So GM, their free cash flow was negative $12.5 billion. Not only are they losing money, but they're borrowing money to hide their losses year over year over year. This is very typical. So this explains why we have a stock market that is overinflated, even though the major corporations are losing money.
I want to stop here for a second. While you were talking, I was trying to find some of that data, but it's kind of funny. I put in Google a search for cash to flow, total U.S. corporate cash to debt ratio. And as I'm pulling this stuff up, there's stuff explaining what it means, but the actual reports, for example, Fortune 500, corporate America has more debt and less cash than ever before. And as I go down here, record corporate cash may hide debt hazard. Companies drowning in debt despite almost $2 trillion in cash, which is what you're saying. The problem is, all these stories are from a year ago. You know, and I'm looking for a more current story, and I have one here, but it's only mentioning the cash and just warning of rising debt. They're not actually given these numbers like you're saying. So it's almost like, yeah, we're telling you, but we're not telling you at the same time.
Yeah, I simply pulled out one example, like General Motors. But I studied Home Depot, and I found that they were running a $12 billion debt year over year over year, but yet they were only making net profit of $6 billion a year, but they were borrowing $18 billion. So they're, in Wall Street, the talking heads will always say how they're always beating estimates and their price of the stock is always going up. Well, they're using all that $18 billion to buy back their own stock and pump it up, even though their underlying profits are going negative $12 billion a year. So this is where I believe the $8.8 trillion is disappearing over the last 8-9 years. It's being funneled through the Dodd-Frank bill, the legal ownership of all that savings has been loaned out to corporations. They're burying themselves in this debt, knowing full well they can't get out of this debt. So when the next financial collapse occurs, like it did back in 2008 and 2009, this will lead to another massive financial collapse, not only in this country, but the same thing is being conducted around the world, over in Europe.
I want to also, if I can stop here for a second, I'm looking at the same article, and you were talking, I was perusing, and it mentions that the cash has risen, but at the same time the debt has, and the debt has outrose, if that's right, the cash by 5 times. So it's like they're making more money, but the debt is way ahead of the game. And I also want to kind of restate what you're saying, that what we're talking about here is the Dodd-Frank bill made your savings account the same as an unsecured loan. For example, if you have a Visa card and you buy a furniture set and you go bankrupt, you say you owe $10,000 on your Visa. Legally, they cannot take your assets to cover that debt. It's an unsecured debt. Now, if you went and signed a particular contract, like, for example, a mortgage, you're putting up your house as a secure for the debt, right? So your Visa card's unsecured debt, which is why they excuse the high interest rates, because they have to pay off the people who don't pay. Well, what the Dodd-Frank bill has done, among other things, is said, okay, when you put your money in the bank, you put $10,000 in the savings account, you are unsecured loaning that to the bank, and they are giving you a return on that loan. So you get, I don't know, 0.5% interest. I don't know what it is. I don't even have savings accounts. You know, I have other stuff. But when you do that, now they have that 10 grand. So now what happens? The bank crashes. You say, well, I got the FDIC insurance. Well, the law about that is, that insurance is there up to $125,000, provided they actually have any money in the insurance policy to give you. So, it's there until it's gone, which some might even say it's technically already gone. And compared to what the savings amount is, it's way, 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 way short of the mark. So what happens is the bank closes up, which has happened in Greece and Cyprus and other areas. They will actually take a portion of your savings to make their balances, to make the balance, if they even can. If they could take it all, it still might not be able to hit their debt. And that's legal. And they don't, and they will owe you that money at some time in the future. This is what has happened in Greece, for example. And this is what is waiting here, and what Lionel is showing is the statistics on the amount of cash these people have, or assets, and the amount of debt. And like you mentioned, Lionel, good example was that at Home Depot, they're borrowing every year more than they make to make ends meet. So at some time, they're not going to be able to borrow anymore. And at that point, they'll have to take their assets to pay off their debts and go bankrupt. Using a bank instead of Home Depot, at some point, the banks will have so much debt versus assets, they will do the same thing, and your money will be taken.
Yeah, that's well said. I should also mention that the reason why I brought out that figure of the savings, I'm comparing that to how much the corporate America has borrowed, and showing that they are just about at the end of their borrowing. Now, the one rule in the entire Dodd-Frank Act that supposedly limits banks from engaging in hedge fund ownership and risky derivatives, the Volcker Rule, is on target to being completely repealed by the lobbyist group headed up by Citigroup, J.P. Morgan, and Wells Fargo. They have already succeeded in receiving an extension through 2017 for the banks to continue their derivative business as usual. So they only have this year left before the Dodd-Frank bill limits their ability to borrow like they have. So this is the end game based on what the Dodd-Frank bill is telling me. They were able to extend it through 2017, but now you have the president talking about bringing back the Glass-Steagall Act, which was the not allowing banks to gamble with people's accounts. But everything is being held off for this one last-ditch year for them to continue their borrowing, and they're borrowing from people's deposits, in my opinion. Now, others might say that they're borrowing from the Treasury or from the bond market, but I'm saying the bail-ins that have been talked about started in 2010 because the taxpayer bailouts really didn't solve the problem of the financial systems, because there were tens of trillions of dollars in the loss columns. So the only way they could paper over their problem was to transfer everybody's deposits in this country over to the legal ownership of the banks and make this game kick the can down the road for the last 8 years. Now, if you don't mind, I'll get to the point where the average person can now possibly turn the tables and make money out of a collapse and not just sit back and do nothing.
Yeah, that's the point. See, one difference I like to do in this show is not just come out and go, the sky is falling, but to come out and go, and by the way, here's some helmets, and here's a shelter, and so on, because it's important to let you know the sky is falling, And before you go any farther, I want to stipulate something, and I think is very important what Lionel and what he's doing here on the show. Lionel, this is not Lionel's line of work. He's not trying to say, and by the way, buy my newsletter, which will tell you these ways to save your money, which you will notice a lot of people doing. He's not saying he doesn't have a financial interest in whether or not you buy or deposit or follow any of these suggestions. It doesn't matter if you do or not. What he's doing as a human being, and God bless him, is coming forward and sharing his information that he found and letting people know, hey, you have an option that you can do that will actually hedge your bet against the market. Just like, and I want to bring up this movie. If you want, you really should see this movie. It's a good movie to watch anyway, as far as movies go, but The Big Short, fantastic movie because they, not only is it entertaining, so to speak, they explain exactly what happened in the housing market and why. And there's people who did this very thing we're talking about. Never been done before. This guy's kind of a rocket scientist, idiot savant type of guy. He noticed that the real estate market was overvalued, and he wanted to start a fund against it. And they all laughed at him and said, "Never happened in history. Never happened in history." And they were sure. They were like, "Okay, we'll insure you. We'll write one of these policies against your investment that we're going to be talking about." And when it was all said and done, his fund returned 4,400% interest return. And another guy who overheard what he did, he personally, by his investments and getting group together, their fund made $2 billion while the market collapsed. Now, it's not, and the second guy really was pissed off that the conditions came about to allow this collapse. So he was really in it to really go after the people who allowed these conditions to cause the collapse. Now, that side, what has happened is there has been funds created based on this same principle. Now, what Lionel's going to go and show you, and again, he's doing this just because he's a nice guy, which I appreciate. I am going to follow his advice. He's going to show some funds he bumped into that actually have a proven past. For example, the last collapse, was it 2008? Something like that. This fund was paid off tremendously. And now, of course, it's low because the markets are record height. But, we don't know exactly how long they're going to stay high. I mean, I would like them to stay high, and we'll see in the amount of investment you would put in, even if it fails, no problem. I mean, I think one of them we'll get to is like $18 a share. And if it does fail, hey, that means the economy's doing well, no problem. But in the past, these have gone up they've gone up to $50, $60, $70, $100,000 a share because of the collapse. And the collapse we're seeing now with the trillions more in the market based on Trump. And I'm a Trump fan, and I hope he succeeds, and I hope it's a great thing. But if they do succeed in either impeaching him or shooting him, God forbid, or something like that, or the neocons going to a war or something, that stock market will crash dramatically. And if it does, for these little amounts, you have insurance. Now, I just wanted to throw it out there, Lionel. I'll leave it back up to you to go through it.
I'm glad you did bring out that story because it's exactly what I'm talking about. Is I believe now we are entering the stage of a massive downturn. Now that might not occur for many months out, but we're pretty much maxed out on the money that can be borrowed out, and a lot of this is not being paid back, and this is creating a problem for the banks. We're talking about car loans, mortgage loans, real estate. It's a massive amount of borrowing that has occurred in the last 8 years. But what I'm going to talk about right now is a poor man's insurance policy against the next financial collapse that I believe is coming up very shortly. And these are electronic trading funds that were created for the purpose of hedging against long positions by professionals that had bet that the market had gone up, but they look at their data, they look at the price to earnings ratio, and they're seeing, oh my, in the past, every time these occurrences occurred, they had to get out of the market and put it in savings. But some wanted to make money on the downside of a market, so they used these hedge funds. Very few people are aware of these downward hedge funds because most people, 99%, are trained and habitually conditioned to buy a stock and not to sell one short. These electronic trading funds deal in indexes. Now, the first one I'll talk about is what they call the financials, and the symbol for that is FAZ, which is an electronic trading fund that bets that when the next financial collapse occurs, that we had occurred back in 2008 and finished on March 9th, 2009. These funds shot up tremendously, this particular one.
All right, now I'm going to stop here. I'll stop here because I got it on the page, and I want to show people that currently, as of this moment, this fund is $18.89 a share, and it has been bumping around. It's been going down over the years as the market has risen. But when we go back to the collapse, we want to go back to this particular, I'm trying to focus in on it. Here we go. November 17th, 2008, the fund shot up to $116,200. And then it went down to 36 along the way, and it had another peak where it came up to $83,000. And then it, as the economy improved, it over the years it went down. By May and June, it was down to 3,000, and I'm just going to January 17th, 11, it was 689, and currently it's 18. And this is because of the dramatic skyrocket of the market up. So, of course, market goes up, these shares go down, because who's going to want to buy a share that bets against the market when it's in record territory? However, if you think that the market will collapse, which is what many have said, and Lionel is saying, and so on, if you can see what happens is from when the market collapse, you just have to look back to the November 17th, 2008, and see, well, what happened to it when the market collapsed? It went to $116,000 a share. Go ahead, Lionel.
Yeah. So here's an opportunity for someone to put, let's say, $200 into this and buy 10 shares. Okay? Let's say that the market continues going up to, let's say, 25,000. Well, you'll probably it will continue going down, and you'll lose, probably $50, maybe 75, whatever. But the upside potential in a financial collapse, as we've seen, if you were to get out with your 10 shares at $100,000 a share, you'd have $1 million. This is what I call a poor man's insurance policy against the next financial collapse. This particular ETF would give you a tremendous advantage in a Great Depression that I believe is being instigated on not only on this country but around the world, because I believe all these banks are interconnected. And this particular ETF financial fund is betting that your European banks, your American banks are all going to collapse at the same time. And that's why you get this enormous amount of money, because in the last 8 years, they've been pumped up with this close to $9 trillion of people's deposits to hide and paper over the real losses that they're losing in the derivative markets caused by the last collapse, where they lost tens of trillions. And so this is just the electronic trading fund pertaining to the financial banks around the world. This is the way a poor person can turn the tables, in my opinion, and now the downside risk has been squeezed out where a poor man can get into it. And
right. If you were, say, you're at August 22nd, 2011, you're spending $946 per share with the knowledge that eventually it's going to collapse. Because back then, people were still talking about, it just got worse and worse. But then with Trump coming in, the market goes up in optimism because of his plans. And again, I hope they work. And if they do work, you're happy, right? Because the world isn't collapsed. It's financial collapse. But even with Trump's plans, and even if they were working 100% without opposition, which we know isn't, it's still mathematically a very high problem, and that the market is bound to collapse to some degree. And say if your stocks went from $18 to $1,000, are you complaining on an investment? No. But if they collapse dramatically, and especially with the volatility of things going on in the world, and they're all pretty much based on the U.S. dollar banks, all the other banks are, if it does collapse, God forbid, you have insurance. And this is why I like your term insurance as opposed to an investment. Because I hate investing in failure. I hope the markets collapse because I'll make a fortune. I got a problem with that. But this is an investment policy. It's just like the farmer who sells his crop before it grows. He'll sell it for less than possibly what he can get. But it depends. If there's a drought and his crop is wiped out, he's paid for. Right? He gets it. If he has a bumper crop, and so does everybody else, he'll actually get paid more than he would have been if he would have sold it on the market. So then again, he works out. But if, but then the investor, who in the case of his crop, the farmer's crop does pay off, but everyone else's, most other people fail, he's going to get a lot lower amount for his money, but the investor makes a lot of money on it. So it's an insurance policy. You die when you have life insurance and you die, yeah, you get money, but you're dead. So you want to stay alive, but in case you do, you have an insurance. So I just wanted to throw that in there.
I should also mention that if a person is actually going to do this, they will have to open their account with a brokerage firm. There's Scottrade, there's Ameritrade, there's others out there, and it would cost probably $7 that once you open that account, you can just make the trade yourself and walk away from it. That at least you got that insurance policy. Oh, by the way, in a collapse, your regular insurance companies will collapse and will never pay off. This is the only insurance policy that I know that will pay off in a collapse, because the money is being held in escrow by all the long positions of all those hard-earned savings that the banks have already gambled into the stock market. So I just wanted to say that is how you do that. You simply open an account.
You want to get into another example? Because this is not like the only one, though I think looks like it might be the best in terms of past performance of tremendous gain and cheapest now. But you got another one you want me to pull up here?
Yeah. Why don't you just pull up any one of those and kind of tell me which one's on the screen?
I got
I'm not watching
this one. I have. I just happen to be next here. It's called VXX.
Okay, this is the one that George Soros is betting heavy on. I think around $2 billion. He got into it a little bit early, and he's lost some money, but he doesn't really care. He's worth about $25 billion. So
let's go up. Let's go back here. We're looking at its peak. March 16th, 2009, it was $29,000 a share. Currently, it's $13 a share. Right. Same thing. You could see from the people watching, you can see as the market recovers, it goes down, and as the market has skyrocketed with Trump, it's down to 14 or 13.22.
And this primarily is betting that the NASDAQ, the whole index of stocks in the NASDAQ, is going to go down. Of course, in the past 8 years, it has gone nothing but up, because you're betting against, in the NASDAQ, there are some very powerful stocks in there, like Apple, that is trading at practically 1/6 of all the value of the NASDAQ, which is about $1,000 a share. There's that one stock. If it was to get slammed, it would destroy the NASDAQ. But Yeah, this is the one that will collapse the quickest and the fastest out of all the, and this is the one you would make a lot of money at on the downside in the next collapse.
I want to mention that George Soros is not doing this for insurance purposes. He's investing in this and actively seeking to have it happen by going out and interfering in governments and bankrolling protests and trying to get Trump thrown out and all this. So he's not looking at it in terms of insurance. He's looking at it in terms of an investment, and I'm going to go out and interfere and cause it to happen. So,
yeah.
The next one we have, is there any more on that? You want to say anything more about VXX?
Well, let's see. Primarily that is a highly volatile one, and it deals with the NASDAQ. We don't know how high up Apple will continue going up, because that is the main thing that's causing the whole NASDAQ to go up, because it's 1/6 of the value of the whole NASDAQ. So if you follow Apple, if it goes down, you can bet NASDAQ will go down, and that electronic trading fund will go up. So, yeah, let's move on to the next one.
I got this one. It's called SRS.
Okay, that one deals in the real estate mortgages, commercial real estate, and all the. See, in this country, there's $14 trillion, $500 billion in mortgage debt that people have taken out for their homes, and this might even include the commercial real estate as well. So in the last financial collapse, real estate collapses right along with the stock market. They all go up together and they all come down together, because they're all loaned out money from the banks, and they're very connected to one another. So the last time we had the financial collapse, we had the real estate collapse, and you'll notice the dates of the SRS. I think it went up to...
Yeah, I'm going to go back here. Right now, currently, it's at $31.99. And going back to its highest peak, July 1st, 2007, it was 6,615, but it had several deep dips and peaks. So the actual highest it was November 1st, 2008, and that was 7,291. So it went from... In reverse, it went from 7,291 to currently 31.
So, yeah, this is just simply a bet that the real estate will collapse at some point in time in the future. So it's another bet against the banks, because when the bank financial system collapses, real estate will go down with it. And I just brought that out. Because I thought that was right now at $32 a share at a potential. And by the way, the next time real estate goes down.
Whoops. We lost connection here. Let me give him a call right back instead of screwing around with pausing things here.
The person you have called is unavailable right now. Please try again later.
La persona que usted ha llamado no está disponible.
All right, well, let me try. There's a function on this thing I can pause. So let me try pausing, and then we'll get back. Well, he's gone. It's been about almost 2 hours, hour and say 45 minutes since Lionel dropped, and I've called him repeatedly, and the phone's not even on. And I did notice that briefly somebody logged on, presumably him, on his Skype account, and I'm guessing he may have tried to, he doesn't actually do computers himself, so he may have tried to went to a friend's or the library, something went wrong, and wasn't able to call, or it's the CIA hacking into his system. So fortunately, Lionel gave 98% of what he was going to do, And the last thing that he was going to talk about was just one more fund. And I can't fill you in on the details of it other than it's in the same vein where, for example, this is a more this is a more recent creation, but in January 8th, 2016, it was $67. Now it's down to 16, and going back in time to December was 53. So it's another fund that is based on market goes down, items go up. Luckily, we went through the highest recommended situation to the highest one were the first several. So, and I don't want to just not put this out there. I don't know when I'm going to hear from him. So I wanted to just finish by saying that what you can do to actually access these items is if you have a trading account like Ameritrade, E-Trade, any of those things, you need to have some account somewhere. And you will type in by these numbers, remember the FAZ, VXX, SRS, and the last one, TZA, and you can get the information of them, and you could watch them on your account, and then for simply, now here's an advertisement right here for Fidelity, $4.95 for an online trade, versus Ameritrade. But anyway, 65 cents per options. I margin rates. I'm not an investor in this, and presumably in this show, I've already talked about Bitcoin. I will put together a standalone like this for Bitcoin as well and other cryptos because those have really exploded, and we want to talk about them and how they work and what is the future plans, and I'm going to line up guests for that. So at this point, I think I'm going to terminate this segment. Unfortunately, it was rough there with Lionel, and I hope he's all right, for crying out loud, but I'll leave it at that, and the links will be underneath here, and if there's any additional items, I will bring it to your attention.